مساء الخير. Good afternoon, everyone. Welcome to our session. What it really takes to fundraising as a first-time fund manager. Now, we typically hear about all the companies closing successful rounds, but we rarely ever think about where the money's coming from, right? Or what it takes to have the funds that actually invest in such companies. But today we will be looking at how. Hello, yeah. Today we will be looking at how LPs who are the limited partners who invest in GPs, interact with the fund managers. Would be looking around how the appetite has changed across the past few years. And we are very fortunate to have a very well-diverse set of institutional investors across the Middle East and African region. But let me quickly introduce our panelists. So let's start off with Paula, Chief Investment Officer at Injas Capital. She will be bringing the LP perspective to the conversation, where she focuses on evaluating fund managers across different asset classes. Mr. Walid, Managing Partner of Sukna Ventures. So while Walid has been instrumental to the development of the asset class in the Kingdom of Saudi Arabia, you've been doing this for 10 years now, give or take. He had recently, compared to his track record, established Sukna Ventures. Thank you for joining us. And of course, my dear former colleague and friend Tamer, a partner at Shuruk Ventures, one of the earlier regional players who are continuing to expand across different asset classes. And of course, Mazen Nadim from Foundation Ventures, the managing partner there, one of those who were able to really carve out something great for the earliest of stages across VC in Egypt. So thank you all for joining us. So to begin with, our region typically has a very diverse set of investors. We have the DFIs, developmental financial institutions, we have the sovereign wealth funds, we have family offices, we have corporates as well. So I would like to start the conversation by addressing the difference in approach for each of those, which channels are most effective, and how do you address or balance the mix in your own funds. So start off with Walid.
I'll probably emphasize the word diverse, becoming more diverse. Definitely we're seeing that in Saudi Arabia, for example. For a long time, banks haven't been... Thank you. For a long time, for example, banks were not involved in the VC asset class. They didn't see it as a serious asset class. That changed rapidly in the last 2 years. We're seeing also endowments considering coming in, which is huge. It's one of the things that our LP ecosystem doesn't have compared to the US ecosystem, for example. And in general, we're seeing more sophistication across the LP pool. Even with family offices, we're seeing that they have specialized teams that understand asset allocation and capital investments, and more maturity in terms of knowing what they actually want. Initially, like a few years ago, it was all about access. They wanted access to the startup world. Now there's more sophistication in terms of what kind of return risk profile that they have in mind, what kind of fund manager is compatible with the portfolio strategy that they have, what kind of relationship they want to build beyond the first fund that they work with that fund manager going forward. So I think also besides diversification, we're seeing a heightened level of sophistication compared to the last few years.
Tamer, Shuru's been around way before the GCC countries became active in this space. So can you please share with us your experience on how the institution helped bridge this to where they are today?
I think one of the most important things that we had to deal with was the question, whenever we wanted to invest in a particular market, the question we always got asked is, do you have local LPs? So I want to invest in Egypt. Do you have a local LP? No. I want to invest in Turkey. Do you have a local LP? No. Right? So the big institutionals, particularly the ones in the UAE who have a much more global portfolio and are quite sophisticated, one of the first questions they ask you is, who's your local LP? And that was particularly challenging in the beginning because there were no local LPs, and even still, there's just not enough, right? And they need an institutional LP. And they need to see that this institutional LP is also taking approximately 10 to 20% of the fund, right? And what a lot of sort of founders don't know, and I assume at least 95% of those in the audience are founders, we work really hard to get you the money that we give you. It's very difficult. And it takes us a considerable amount of time and a considerable amount of conviction, and we have to convince LPs just like you have to convince us to give you the money.
No, I'm sorry. I wish it was as easy for them to convincing us. You remember Fund 1, it took us 3 years to close?
I was there, yes, I remember that.
You remember that, right? Yeah. I'd like to see a founder who's waiting 3 years to close a round, if any.
But once you start having a healthy local LP ecosystem, then things become ever so slightly less difficult, right? But you need to work very closely with the public sector, with institutions in your local ecosystem to make sure that you have someone local in every market that you want to invest in, which is really hard.
Okay, so let's bring the Egypt side of the LP equation. Mazen, can you please share your, let's call it different mix to the standard financial institutions and DFIs, how you've approached it and how are you building it to make it more sustainable for you as an institution going forward?
I think sustainable is the wrong answer, but I think we tried to take a very different approach, which I'm not sure whether it will yield positive results or not. But we tried to go down the complete sort of family office route in the beginning, trying to capture industry leaders within their markets and then be able to utilize and leverage their resources to plug them into the companies we invest in. So very different approach to LPs. And then that was the first vintage, and then we slowly started to realize that in order for it to be a sustainable sort of LP network, we would need to be able to get the institutionals as well. So then moved on to sort of fund the funds as well as now DFIs.
So let's shift to the LP side of the equation. Paula, what do you typically look for in a first-time fund manager, or do you even look at first-time fund managers altogether?
That's a really good question. And to be completely honest, we're looking at first-time fund managers, and for the matter of fact, we are one at the moment, and that's why we're extremely cautious. But maybe I can give you an example from our LP experience. Since most of our investors base is GCC, I would say very regional, we always look at funds that can, which can add additional value else than simply the returns. So especially for family offices and for the clients that we have in particular sectors, especially like finance, logistics, healthcare. I think that the synergy that you can have with those funds and the first access to deals, co-investment, we always look to the benefits, additional benefits of investing to a fund, not simply the potential returns. And then I think that the sector, the VC space really matured in the last few years in the region, especially UAE and Saudi. Now we had seen also Beko Capital launching another 2 funds. So it's a bit easier to pick up because all of those names already have established really good track records, which makes our job easier. And also most of the funds are in established sectors, for example, like fintech, right? That performed really, really well. So you approximately know what to expect. I would say that regionally, I'm way more excited to see a bit more diversification in terms of niche funds. Right now, mostly what we're seeing is generalist. And we have some mixture. They're trying to invest in this and that. But if you look at the track record, mostly the success is driven by the very well-known type of investments like the fintech side. And then the rest are small tickets here and there. More excited to see very specialized funds. Like I think I saw a few days ago a specific biotech fund launched in Saudi Arabia for the first time, which is very, very interesting. And it's a very niche market. So I am interested to see how that would go. But then to give you also the perspective as a first-time GP and the experience. Actually, I really believe that the whole process is a bit like a domino. You obviously need to have a really good mixture of institutional LPs, international investors, the local family office, and mostly the investors that provide you access to the ecosystem, because without them, how you can grow your portfolio, how you can provide the access. But I believe that it's exactly like domino. You just talk to everybody, and once, usually it is when they come in, I'll also come in. So for a 3-year fundraising process, probably you know that very well.
Speaking of when we spent 3 years raising Fund 1, back in the day we had the DFIs, most of them had special programs for first-time fund managers. They were actively trying to build this. But at least on the DFI side, out of all the ones that had it, I can only think of one that is still backing first-time fund managers. But other than the DFI world, from your own LP base, how do you see the shift happening? Is it still existing? Let's start off with the Saudi market. Walid.
Could you elaborate a little bit about what kind of shift we're talking about?
The shift in prioritizing first-time fund managers or facilitating programs for first-time fund managers.
Got it. At least in Saudi, when you talk with institutions, a lot of them care about and filter for established managers. And the definition for established, just like anywhere else in other markets, is a fund manager that has at least 3 funds already deployed. Some of them are very clear about that kind of limitation, and there's still a challenge for new and first-time managers to approach them. Having said that, because of the diversification we were talking about, corporate VCs coming in, the banks, the endowments, more family offices, even high net worth individuals coming in. Some of them actually have different other priorities as well, besides the whether the team is established or not. So, for example, alignment with what they're looking at in terms of sector focus, for example. Another one could be the relationship and how they view the fund manager in terms of trusting that fund manager for the long term, and getting exposure to the things that they have in terms of the network that they present. Another one, which is also kind of not under your control, is timing. And this is something that fund managers don't take into consideration. Sometimes they like you, you check all the boxes, but it's just the wrong timing, and for whatever reason, you came them at the wrong time. In my own experience, I would say at least of the third of the rejects that we had were due to timing, nothing else. So we plan on coming back to them for the second fund.
Well, here I just have one thing to add. Similar to startups, we expect that people who backed us initially would continue to back us to build something, a great institution. But this is where the thing comes from. Well, I understand, of course, the timing and the mandates makes a huge difference. So, Tamer, Shuru, Bismillah, mashallah, keeps on increasing funds when it comes to strategy, when it comes to mandate, even the type altogether. So, when you're building for such funds or raising for such funds, do you keep on getting treated as a first-time fund managers? How do they balance it out?
I was just talking about that before the panel. So what we've learned is that globally, there are pools of capital. These pools of capital don't intersect. They don't like to work with each other, right? So if you go to the sovereigns and the DFIs and you tell them to come into one fund, that's not going to happen. If you go to the banks and the DFIs and they want to come into one, that's not going to happen, right? So we were hitting our heads against this brick wall for years, trying to bring, and I wrote opinion pieces, and I spoke on panels, and I did so many things. And you know what? The honest truth is I give up. I stopped trying to convince them to come into my products. Instead, I ask them, what do you want? And then I just build the product for them. Whether that translates into a fund, a separately managed account, an entirely new asset class, it doesn't matter. So long as it's within my core competency and within the skill set that I am capable of delivering on, and I am committed to delivering on it, I will launch a new product.
تريح الزبون إيه؟
They're my customers.
Yeah, exactly.
My LPs are my customers, not the startups. The startups are my stakeholders, right? But my customers, the people who pay me, are my LPs.
That's such a nice point of view.
Thank you.
Okay, so Mazen, let's talk about your strategy, your fund size. How much of it was determined by your potential LP base versus what you initially wanted to go, and how do you build a firm around evolving this?
Yeah, absolutely. I think this is one sort of topic that we internally keep going back and forth on. And naturally, as a pre-seed seed investor, we generally want to have a smaller sort of pocket of capital to deploy in an early stage with smaller check sizes. The way we wanted to construct our fund was that we wanted to be super concentrated on a smaller portion of investments and have extreme conviction over these companies, and accordingly have a smaller portfolio but have a sizable ownership within these companies. What we realized is that with a smaller fund, you're unable to attract certain sort of LPs. So when it comes to potentially DFIs, there's a certain threshold in terms of what they're willing to do and what they're not willing to do. That's ultimately based on bandwidth and based on time spent on that fund versus spending it on a larger ticket
Let's call
size.
it timing.
Correct, if you'd like. But yeah, we had to learn the hard way how to ultimately navigate these different LPs based on different font sizes, based on geography, based on what we're actually deploying in. So ultimately, the evolution of the fund is that you get to a stage where you are sizable enough for these LPs, but at the same time, you stay true to what you really want to actually achieve. And I think we were actually having this conversation earlier on, whereas we are looking to, in the end of the day, generate returns for our investors, and ultimately, the lower that threshold to be able to make those returns, obviously, the faster you'll be able to return and then compound on top of that, especially in a market like ours or in a in our region versus potentially the West, where you do not usually generally see these sizable sort of outsized returns where you can multiply on $200 million funds and so on. So the idea for us is that we wanted to reach this size where we can attract those LPs, but at the same time stay small, nimble, and agile to be able to deploy in the local market and in neighboring markets as well.
Thank you. So Paula, as an LP, how active are you in trying to shape strategies or even firms going forward? Or are you more concerned or focusing on the governance side of it rather than being, let's call it, actively managing the fund manager?
Well, definitely, we are usually a minority stakeholder, so we didn't have the experience so far where we are trying to manage or define the strategy. At the end of the day, I think that the funds come to you with a ready product. Tamer here shared a very interesting perspective, how he goes to the LPs and then he shapes whatever they want. But usually the way it goes is that most of the funds, since we don't do first-time fund managers, usually they already have a very well-defined strategy. They have an idea for the fund. They have the anchor LPs, and then they come to firm like ours. So they already have the ready offering. So for us, definitely, we're looking at the governance, at the track record of the exit strategy. And for us, again, since we are also looking out for our own investors, we are very particular about what is the value out of investing of this fund else than ROI, because we're actively generating ROI. There are multiple asset classes, and then if we are going to an early stage fund where you're locking your funds for an X amount of years, then you definitely want to see some extra benefit, right? Which can be the co-investing, can be regional exposure, can be multiple factors. So I would say for us to make a decision, that's the key thing that we're looking, what else than the ROI we're getting alongside the fund.
So for the sake of time, I will kindly ask each of you to give a very brief piece of advice for anyone here who's an aspiring first-time fund manager? So, please, Walid.
Thank you. My advice here is for any new GP, they need to realize that there are two games in town for GPs. Either you're a boutique fund focused on returns and scaling returns, or you are a bigger, much bigger fund that is also considering AUM and the needs of LPs that are looking for larger ticket sizes. They're all valid, they're all good, but you have to pick one. The ones in the middle, these are currently facing pressure because they're not appealing to either side of the equation. So just make sure what game you want to play in VC and stick to it.
That's a very good piece of advice, by the way. If I were to pick something, I would say be flexible, right? Don't be rigid. You'll get folks who want to back you, not the right time, maybe slow down, pivot, find other people until you find your sweet spot, right? Until you find your product market fit, right? So adjust, listen to your potential customers, your LPs, understand what they want, and if it is something that you're passionate about, do it, right? So don't be so rigid that you, quote unquote, price yourself out of the market or push yourself out of the market. Be flexible, listen to what your customers want, and if it works, do it.
Now it's working. I would say that the first time GPs are usually targeting smaller funds more as a proof of concept. So what I would say is like build your team systems and governance as if you're building for a 500 million fund or as if you're building for looking ahead for fund 4 and 5. Before you're approaching the LPs, and I think that this is the one maybe single key factor that can help you bring you to the success.
I think my advice is don't do it. No, I'm only joking.
No, this is the
Don't
advice
do
I
it.
give founders.
That's
Don't
the
do
best.
it.
That's the best advice so far.
but on the contrarian side of the argument, I think aside from listening to your customer, which is the LP, I would honestly look at it from a different perspective and actually look at what you're actually passionate about, what you think you can actually solve for in terms of the market that you're operating within. And if you believe that you found some sort of a wedge into that market, then actually do it and go for it and follow what you truly passionately believe in rather than following the money or following the LPs. I think once you've been able to define a true strategy, then you'll be able to ultimately find people that are believers in that strategy and ultimately back you.
All right, so this concludes for our panel, and thank you all for taking part of this. It's been really a pleasure and very insightful. Thank you, Walid, Tamer, Paula, and Mazen.
Thank you, Brahim.
Thank you so much. Pleasure being here.